Good evening, everybody. Thank you very much for your time. My name is Russ Mould. I'm AJ Bell's Investment Director. And thank you for giving up some of this spring evening to listen to this webinar on investment trusts, what they are, how to research them, and how to use them. You're welcome to ask questions at any time during the presentation in the questions box in the control panel on the right-hand side. Please don't be shy, because the only people who can see them are myself and my glamorous assistant Michael Tyers, who will be moderating. And I will then certainly take as many of those as I can at the end of the session and answer as many of them as I possibly can within the time that we've got. If you have any technical problems, I start speaking too quickly, use any jargon you don't understand, again, please pop that up in the questions box and we'll help you out as best you possibly can. And note that about an hour after we finish this evening, we'll send you out an email asking you to fill in a little feedback form, tell us whether you thought today was good, bad, or indifferent, and that will also give you a link to where you can download today's slides. If at the end of the session something occurs to you later, you're always welcome to contact me directly on my email, which is russ.mould@ajbell.co.uk. I'm now going to crack on with the presentation, leave time for questions at the end, and we'll be finishing at 6:30 on the dot to help everybody get home or continue to enjoy the rest of their evening. So just as we move on to the first slide, which is the risk warning, it's very important that you just have a quick look at those with regard to issues such as tax, which we'll talk about, past performance, advice, and also the value of any investments that you make. So thank you for reading those. This is now what we're going to be looking at for the rest of the evening, looking at the concepts of collective investment funds, how investment trusts, what they are, and how they differ from other types of collective investment, a little section on tax, and then perhaps the meat of the presentation, certainly for those of you who are a little bit more experienced, how to research an investment trust, perhaps where to find some information, and then a few conclusions before we go into your questions. So just flip over onto the next slide. So, routes to market. You obviously have two options. You can do it yourself. You can pick your own stocks, bonds, funds, for example, and you can do this on an execution only or DIY basis where there's nobody involved except yourself. You can take financial advice. You can even go down the full discretionary route if you wish and let somebody make the picks for you. Again, whether that's in individual stocks, bonds, or other asset classes which have become popular over the last 5 or 10 years, particularly for their yield angles like, say, property, or even, dare one say, alternative assets, though, such as, let me have a think, art, wine, cars, books. Though clearly there are lots of other issues that you need to address there, which we won't be looking at in detail this evening, such as how do you insure these assets, how do you store them, the costs involved there, and then other issues such as fraud, where if anybody is out there looking at wine, for example, I can thoroughly recommend you a book by a guy called Benjamin Wallace called The Billionaire's Vinegar. I won't give away any more because it'll spoil the story that you can probably guess from the title. But we won't be looking at alternatives tonight particularly, although investment trusts can be very active in some very niche areas as we'll come back to. So one route to market is that you do it yourself or with the assistance of an advisor, and you pick individual stocks or securities between you, doing your own research. Just before we clear, just hopefully we've not had any feedback yet, but hopefully everybody can see and hear clear. Okay, if there are any problems, please do let us know. So that's the direct route. The indirect route is what's known as a fund or a collective, where you don't have the time, the expertise perhaps, to make your own selection. I suspect that time is probably the bigger problem. Not all of you will want to go home after a hard day in the office and then start reading the Tesco report and accounts, for example. I do, because I find it really quite interesting, but I accept that not everybody does. So if you're not prepared to sit and read that and go through the accounts, study the company's competitive position, its management, its business model, and all of those other important details for the long-term investor, then a fund is one possible option. Your cash is pooled with that of other like-minded savers, and for a potentially very small investment, you can gain access to 30, 40, 50, or 100 individual stocks or bonds or properties, for example, and therefore get diversification to manage your downside risk, so you don't end up with a portfolio that's perhaps too concentrated, but hopefully equally one that's not so diverse that it starts to dilute your potential returns. And so what you get here is you save time, you get access to expertise, you get access to diversification. The catch, of course, is that you have to pay for those services, and it comes in the form of the fee charged by the fund provider, whether that's for an individual fund manager, actively run, or, as we'll come on to later, passively run, where basically a computer program is building a portfolio to track an existing index. So when it comes to the collective route funds, again, where your money is pooled in a shared collective, there's a huge range of things in which you can invest. Stocks and shares, bonds, tradable loans, property, commodities are classic examples, but geographies, you can do something that just focuses on the UK, you can go global, you can focus just on emerging markets, and examples of investment trusts here, and I stress they're just examples, would be Fund Smith Emerging Equities, JP Morgan Emerging Markets, or Utilico Emerging Markets. If you wanted to target a specific country, you can do, with say Fidelity China Special Situations or Aberdeen New Thai. So you can get very, very broad, global, or very, very granular and very, very narrow, targeting one specific country. You can look at industrial sectors or themes. You can then look at maybe alternative areas if you're feeling a little bit more adventurous and you're a little bit more experienced. You can look at private equity. You can look at hedge funds, for example. Daniel Loeb's Third Point and Bill Ackman's Pershing Square. There are both investment trusts available in London. You can go multi-asset, multi-manager. Forel & Colonial, for example, runs some investment trusts of investment trusts. So again, that takes all the stress out of it in exchange for a fee. A gentleman called Peter Hewitt will build a portfolio of investment trusts for you. And you can also look at venture capital, which is, I guess, want of a better turn of phrase, a dragon's den style investment. We're looking at very young, fledgling companies. One of the advantages here is, apart from the potential upside if one of those companies makes it big, is that the manager will, or through the manager, a direct subscription with them, you will get tax relief on your investment up to £200,000 a year. And then, providing you hold on for 5 years, there are also tax benefits in terms of dividends and capital gains at the end. So there's a wide range of options here available to you in terms of asset classes and appetite for risk, how far you want to go up the risk curve, whether you want to look at fairly well-established developed stock markets like the UK or the US, or go right to the other end extreme and look at venture capital and very young startup companies. So this next slide then just gives you an example of the different types of fund that are available to you. And I'm grateful to my colleague Ryan Hughes, who's our head of fund selection, for drawing this to my attention. So you have multiple options available to you. Right down in the bottom left-hand corner, you have what we would call pure indexing, which would be a tracker fund or an exchange traded fund. Again, a tracker fund, they're designed to follow a basket of securities and deliver that performance of that basket minus their running costs. So if you were to take, say, a Vanguard FTSE 100 fund, it will deliver the return of the FTSE 100 minus its cost, which last time I looked is around 0.07%. So that's pure indexing. You know exactly what you're going to get. Index goes up, tracker goes up to the same amount minus the costs. Index goes down, tracker does the same, again with the running costs knocked off. You can then choose between whether you want to find a fund that is, very actively run, where it's definitely whether you have a fund manager who's making calls, who's expressing a strong preference for a geography, sector, or stock, or somebody who's taking a little bit more of a cautious approach and maybe hugging the index more closely. So in the bottom left-hand corner, you would have what we would call closet indexing, where somebody's allegedly running an active fund but isn't doing too much that's dissimilar to the benchmark, and that's an area where the Financial Conduct Authority is getting pretty stiff right now, on the grounds that classic tracker funds are miles cheaper than active ones, and it wants to make sure that if somebody is charging an active fee, they're doing active management. On the top left here, diversified stock picks, strong views on individual companies, but with a broad portfolio to manage the risk is another option. Top right, concentrated stock picks with perhaps very few companies in the portfolio, maybe as few as 20 or 30. That is perhaps where you would get the most active form of management. And here you do have a difference in that because an investment trust is not deemed to be regulated by certain European rules known as UCITS, an investment trust can own more than 10% of its assets in one particular security, something that other funds can't necessarily do. The other option is in the bottom right, factor investing. This goes back to more passive type of funds, ETFs, but there you'll find an ETF that is run according to a certain theme or screening methodology. For example, UBS runs some really interesting ETFs that look at corporate governance and socially responsible investing, but you can factor for momentum, for income, for value, for example, and again, the computer algorithm will do all the work for you and pick, maybe 100 or a couple of hundred stocks that fit with those criteria, and then track that custom design basket. So you have lots of options available to you in terms of how active you want a fund to be, whether you want it to be purely passive or focus on a particular theme, in the knowledge that you either track an index very closely, or in return probably for a higher fee, you will be targeting premium returns in the knowledge that if a fund manager gets it wrong, and let's face it, they're only human, there will be quite wide potential scope for underperformance in the short term. I think, again, what you've probably got to do is judge your fund manager actively over at least 5 years, probably even 10, which is the optimal time horizon you're looking at stocks anyway. But even if everybody has to publish short-term quarterly performance. So that's the sort of different styles of fund that you can get, whether they're active or passive. And just to look then in a little bit more detail at this debate, let's look at the active funds, because that's what we're talking about tonight. And again, you've got a couple of main types here. On the left, we have what are known as unit trusts, or they used to be called OICs, open-ended investment companies. They're now called investment companies with variable capital, or ICVCs. Let's call them funds for short, because it's nice and easy. That's what they are. And they're open-ended, so there's no limit to the amount of cash that can be put in them. If lots of investors put money in, the fund manager will create new shares, new units, go out and then put that money to work, buy the portfolio, and you will have a share, your percentage share of that pool of assets. They come with income or accumulation classes. Income means the dividends are paid out to you. Accumulation means that the dividends are rolled up into new shares and provided to you. And again, to research them, you must read the key investor information document, and these funds are subject to UCITS rules, undertaking which are European regulations, again limiting, for example, what they can invest in. UCITS funds are not allowed to invest in stuff, real things like commodities, for example. There's a limit to the amount of cash they can have in them, 20%. There's a limit to how much they can invest in any one particular security, 10%. So there are some rules there designed to safeguard the investor. Investment trusts, a different structure. They're closed-ended, permanent capital. So once the investment trust raises its money, that's generally pretty much it, though they can do a follow-on if they want. But here what you do is you don't put your money in a pool and get a share of the assets. You buy a share in the company which trades on the stock exchange. Now with a fund on the left, if you want to buy or sell them, you can probably do it once a day, normally at midday, and you put in your order, and you don't actually really know what price you're going to get. You've got a pretty good idea, but not exactly. On the right, with an investment trust, it's quoted on the stock exchange. You can see the price on the screen during trading hours. You know exactly what you're going to be getting. So there's a slightly different structure here. So the unit trust, money will flow in on the funds on the left. Money will flow in, money will flow out, giving the portfolio manager an issue, which is, you are paying that portfolio manager not to sit in cash, but to put the money to work. So that's what they will do. On the right-hand side, the investment trust isn't subject to these flows, so they can perhaps take a little bit more of a longer-term view, and that's why some people like this what's known as closed-ended structure, where you're not buying, again, a share of the pool, you're simply getting a quoted share. Now, there are lots of different flavors of investment trusts. I won't go into huge amounts of details today. Venture capital trusts is one. Real estate investment trusts is another. Splits is where there's actually a second class of share which comes with a predefined maturity period almost. But investment trusts, I should say, are actually the oldest type of collective investment. The very oldest foreign and colonial investment trust dates back to 1868, and I think there are at least 25 investment trusts that are over 100 years old, including Dunedin, Witan, Merchants and Lord Debenture, for example. So these are pretty resilient structures. They've survived 2 world wars, the Great Depression, the financial crash, and goodness knows what else. So this mechanism is proven. And again, To understand them, you've got to read the key investor information document, the fact sheet from the provider, but again, they're non-UCITS, so they have a little bit more leeway in terms of what they can invest in relative to the funds on the left. They can run more concentrated portfolios, for example. So this is all a little bit technical. I don't want to go into huge detail on this table, but this tells you exactly what you're getting. I think the key issues here for you as investors to be aware of, the second line down, open-ended or closed-ended is important because that's the structure. That's how you actually get your money into the investment, get your exposure. The two on the left, the unit trust and the funds, your money is pooled. Investment trusts on the right, you just buy a share in the existing portfolio. Supervision we'll come back to, the fourth line down. Investment trust on the right hand side, there's actually a board. This is a company, so you actually have a chairman and a board overlooking your interests, defending your interests. Borrowing we'll come back to. Investment trusts can actually borrow and, quote, gear up. And then in terms of actually getting access, the price that's quoted, as you can see, there's a bid offer spread with investment trusts, just as there is with a share. And the valuation, the price that you get, that is set by simple supply and demand in the market with an investment trust. You'll see it on a screen on the strip, and then you can decide whether that you think is a good price or not. Whereas when you buy or sell an investment trust or a fund, or sorry, a unit trust or a fund once a day at 12 o'clock, the valuation will be set according to the net asset value of the portfolio. Investment trusts, as we can see, will trade at a premium, rarely, usually a small discount to the value of the underlying assets. That's largely as a reflection perhaps of, I guess, the risk of manager error, potential tax issues, but also whether a particular investment trust or area in which it's operating is currently in or out of fashion, seem to be performing well or not. So let's compare and let's look at it in why do you put your money into a fund? Why do you pay for the fees? Performance. So let's get down to the real meat of it now. How do you compare performance? This is one of the questions I got in advance, so I'm dealing with it right here, right now for you. How do you compare performance of funds against investment trusts? There's an old market saying, which is investment trusts are bought and not sold, on the grounds that investment trusts were terrific long-term investments, whereas funds were sold by financial advisors because in the bad old days, they got a commission on those through the trail from the fund manager. The Retail Distribution Review did away with all of that. There's no commission now for financial advisors, no commission on funds, no trail. And so in some ways on a fee basis, it's now a level playing field between the two. But generally speaking, you did find that an advisor would always go for a fund rather than an investment trust. That's not the case now, but the old saying is still around. And the closed-ended structure of investment trusts still is perceived as an advantage because the fund manager often will find in an open-ended fund that he or she is operating in a popular sector or their performance is strong, and money will flood into their fund and they have to go out and put it to work, sometimes maybe near the top of the market. Equally, stock market psychology being what it is, they'll then find themselves with redemptions and people wanting to take money out if the performance starts to ebb or their sector falls out of favour, maybe forcing them to sell near the bottom. That does not happen with investment trusts because the capital is permanent. It's the shares that are changing hands. So the actual pool of assets underlying is not affected, giving the investment trust manager perhaps a chance to operate on a longer term time horizon. Now the question I got was, how do you actually compare this? And I have to say it's the devil's work. It's slow going, and I've got to be careful what I say really, because on AJ Bell's website, the Youinvest website, you can look at Morningstar data, but I have to admit it's easy to do this using the TrustNet website, which is the data that we don't use. On the TrustNet website, you can search by fund manager, and then you can actually see, say for example in the case of Mark Barnett of Invesco Perpetual, which funds he runs, which investment trusts he runs. You can then see which one is comparable with the other, and then you can check out the comparable performance data. So it's laborious, can be done. Now, the broker Canaccord Genuity, who have actually got a dedicated investment trust team, did publish a report in the first quarter of this year saying that 51 investment trusts actually had the same mandate and were run by the same manager as their equivalent fund. And there are examples I can give you here, such as Edinburgh for an investment trust, Invesco Perpetual High Income for the fund, Fidelity Special Values for the investment trust, Fidelity Special Situations for the fund, and Jupiter European against Jupiter European investments on the fund side, all run by the same managers, Mark Barnett, Alex Wright, and Alex Darwell. Now, according to the Canaccord Genuity numbers, only 45% of investment trusts were cheaper, but 32 of the 38 with a 5-year record actually outperformed the equivalent fund, and 4 did it by 4 percentage points a year or more, which is not to be sniffed at. And the outperformers were Baillie Gifford Japan, Impacts Environmental Markets, Baillie Gifford Shinupon, and Monks, which is MNKS for the EPIC. Only one open-ended fund managed to turn the tables, and that was Threadneedle UK relative to the Threadneedle UK Select Investment Trust, and that Threadneedle UK Select Investment Trust is in the process of being wound up and merged into Henderson High Income anyway. So the lower, historically investment trusts have come with lower fees, because I think that has helped a little bit, but also the permanent nature of the capital structure does, in the eyes of an investment trust manager, bring them some advantages. Now, in terms of tax, this is just a technical point. An investment trust is a company, so therefore it does actually pay income tax, but it doesn't pay capital gains tax, though it does pay stamp duty in any transactions. You, as the investor, may pay income tax on the dividends that you receive, depending upon how much, because there is the £5,000 dividend income threshold introduced by the Chancellor last year. And also you do then, of course, have whether you hold the shares in the investment trust in a dealing account rather than an ISA or a SIP, because in an ISA or a SIP, there are obviously tax breaks there. You will be subject to capital gains tax and certainly stamp duty buying and selling the shares, but again, on the capital gains tax, on the income tax side, if you're holding an ISA or a SIP, then there are the natural benefits thereof. So that's some of the technical stuff. Now, let's get into the real meat. How to pick one. How do you pick and research an investment trust? Now, the good news is our website features all of the major investment trusts. You can read the fact sheets. You can then obviously go to the individual fund provider's own website and read the material. And I should say that the Association of Investment Companies website, www.theaic.co.uk, is very good as well. Not all investment trust companies are members of the AIC, but a pretty big chunk are thereof, and there's some good educational material there, as there is on our own website. So, how do you go about picking an investment trust? I should also say, by the way, that there are actually investment trusts of investment trusts. So if you, again, come to the end of this and think, gosh, this is hard work, again, I don't want to go home and think about all this, there are some investment trusts of investment trusts. One example is F&C Managed Portfolio, run by a guy called Peter Hewitt, and this checklist of 10 things on how to pick an investment trust, I got it from him. So thank you very much, Peter Hewitt. Credit where credit is due. So, how do you pick an investment trust? Well, these are the 10 things that I think you need to look at. Mandate, style, fund provider, manager record, and obviously fund performance, even in the knowledge that that's only historic, and as we know, the past is regrettably no guarantee for the future, but it's the best that we've got. Fees, process and resource, discount to net asset value, dividend policy, gearing, and board composition. So let's walk you through these one by one. Mandate. Before you commit any capital, any money, take any risk with your money looking for a superior return, you need to know, why are you putting your money at risk? What is your time horizon? What is your target return? So how much money have you got now? How much money do you want and when do you want it? Because that will give you your idea of a target return. And ultimately your appetite for risk. And in investment terms, remember, appetite for risk is defined as your willingness and ability to withstand losses in pursuit of positive long-term returns. So clearly, if you want something that's fairly cautious, you might not necessarily look at Aberdeen New Thai, something that's focused just on the Thai stock market, for example, no matter perhaps how enthusiastic you are about visiting Thailand on holiday. So you need to know what the investment trust puts its money into. And as we've discussed, there's a huge range from stocks to bonds to private equity to hedge funds. So there's a full range of risk spectrum available to you. Second thing you need to think about is the style of the investment trust. Are you, again, this will come back to these 4 questions here. Are you looking for income? Are you looking for capital growth? Are you looking for a combination of the two? And again, if you're looking for income, you'll naturally gravitate towards equity income and fixed income and bond funds. If you're looking for capital growth, you may look for something a little bit racier. You know, Scottish Mortgage, for example, has just raced into the FTSE 100, the 4th investment trust to feature in the FTSE 100 after Edinburgh, which was a founder member in 1984, then Foreign and Colonial, and then Alliance Trust. or you're looking for a combination of them. You know, Aberdeen smaller companies, for example, smaller companies income, I think it's called ASCH, has about 10 bond holdings and 40 or 50 equity holdings. The bond holding providing a bedrock of income, and then some equity income on top of that. So again, it's do your research, but make sure have to make sure that the investment trust operates in an area that suits your requirements: income, capital growth, or a combination of the two. Then you look at the fund provider. You know, that people will to a degree naturally gravitate towards a brand or a name. You'll certainly want to feel safe with them in terms of their reputation. You'll be interested in their range of products. And yes, go to their website. Look at the research and tools available to you. Are there teachings on investment trusts? Are there videos? Are there fact sheets explaining what the trust is all about, who the manager is, how they work, what their style is? And the more comfort you can get, I'm sure the more reassured you will be within trusting that fund provider with your hard-earned money. We do have to look at the record of both the investment trust and the individual fund manager or fund managers. This is all readily available on the AJ Bell Youinvest website using Morningstar data, on Morningstar's own website, on the TrustNet website, on the Association of Investment Companies website. It's free, it's readily available for you, and you can quickly compare investment trusts within their own sectors and against those of others. You clearly will be looking at lots of fund managers are paid to perform relative to a benchmark. I suspect that you'll be more interested in absolute performance because you can't take relative performance to Sainsbury's on a Friday evening. If you wish, you can look at things like Morningstar star ratings or TrustNet crown ratings. The FCA is very keen that people just don't follow those blindly, but they can be a potential guide to long-term quality and long-term performance, even if we must all acknowledge the past is no guarantee for the future. And again, on the TrustNet website, by looking for a fund manager's name, you can find all of the individual funds and investment trusts for which that person is responsible, and do a compare and contrast, if you wish, of the performance differences between the two. Now, we said right at the start that one of the reasons that you may choose to go down the collective route is because you're busy. There's a time saving here by getting an expert to do the dirty work, the hard work of the research for you. In exchange for that expertise, there is going to be a fee. The average, according to the Association of Investment Companies, from their membership, the average ongoing charge figure right now is around 1.25%. Some investment trusts will charge in performance fees on top of that, though that's becoming quite rare. And in a post-RDR world, I mentioned that Financial Conduct Authority regulatory intervention on fund fees a few years ago. Around 40 investment trusts actually now have abolished performance fees altogether, and more than 90 have adjusted their fees, with the majority, I stress, coming down, not going up. And that is a competitive trend there. Investment trusts are competing with other actively managed funds, those unit trusts and ICVCs, and they're also competing with the passive funds, which, to be fair, Vanguard, the world's biggest provider of passive funds, received more customer assets last year than every other fund group in the world combined. So passives are on the rise at the moment because of their low cost. But again, obviously with passives, they will follow the market up, but they will also follow their chosen basket of securities down as well. So they're not, at the moment with markets rising, people do tend to forget about the latter development sometimes. Whereas certainly what an active manager would argue is they'll give you upside on the way up premium, and they will manage your risk and fall less than the market on the downside. That's certainly at least what you're paying them for. Now, what are you actually getting for those fees? That's what you're looking to investigate on the right-hand side. How many people are working on the portfolio? Is it just one girl and her dog? What happens when she goes on holiday? Are the thing going to sit there doing nothing for 2 weeks? So you need to work out how many people are involved in the portfolio. What research backup do they have? Do they just rely on broker research from third parties? Do they have their own in-house research team? Do they have a strict screening mechanism, a proprietary approach that they use? What do they offer? So you're looking at the process, the style, the philosophy. You know, is this a company where if they have a shareholding, they see something they don't like, they just sell it? Do you have a company where so that's an active, really a passive active shareholder, as it were? Or do you have your money with a manager who, if he or she sees something they don't like, they'll pick up the cudgels and take it to the company? Now, we've seen Schroders today disagreeing with Tesco's over its acquisition of Booker. I think that's probably pretty exemplary in terms of what a fund manager is doing as a steward of your capital and the steward of the company. I think, listening to Nick Kirridge on the radio this morning, on Radio 4, they've clearly tried to, have this discussion in private, feel they haven't gone anywhere, and they've gone public to try and flush the issue out. They are there, not just sitting back saying, oh, we don't like this very much. They're actively engaging with the company. You could even go to the right to the extreme and get involved with an activist. Third Point Offshore, run by Daniel Loeb, or Pershing Square again, run by Bill Ackman. They don't just take shelling of the company and poke management. They will often actually look to get involved in the running of the company, maybe even have board representation through their colleagues. So you can, again, what is their philosophy? What is their style? How do they look for companies? How do they go about it? All of these things, may, for example, make a big difference to how you view an investment trust and whether you feel it's comfortable for your style or not. And certainly in terms of management, for example, Keystone has been managed by Mark Barnett in Invesco Perpetual for some time. He's now just in the process of handing this investment trust from UK All Companies over to James Goldston. So you think, okay, who's James Goldston? Well, he's been a portfolio manager for 15 years, and he's had 5 years in Invesco Perpetual. Clearly a very experienced guy, immersed in the culture of Invesco Perpetual and its process. You're clearly going to get what on the balance is a pretty smooth handover. And that's clearly going to be very reassuring for somebody who has bought shares in Keystone over the past few years to get access to Mark Barnett's expertise. Now we're going to get access to James Goldston's expertise. What else do we look at? Two other key, the bit more technical, well, certainly technical issue on the left here, discount to net asset value. As I mentioned with unit trusts or with ICVCs, the price you get when you buy or sell reflects the net asset value, the underlying worth of the portfolio. That isn't the case when you buy or sell a share in an investment trust. The share price is driven by supply and demand and the usual vagaries of the stock market. Normally, stock investment trusts trade at a discount. They can trade at a premium. Now, according to the average, the Association of Investment Companies, the average discount right now is around 5%. Some investment trusts actually have a policy whereby they look to limit the discount, and they do that through buying back their own shares. Troy Income and Growth is one example, Personal Assets is another, and I think Alliance Trust and Foreign and Colonial Investment Trust also have policies in place to limit the discount. Lots of shareholders are put off by a big discount. It means they think that the market's telling them something's going wrong, or the fund manager's not doing a good job. So some investment trusts will actively manage that discount to provide reassurance and say, yeah, if it gets to a big discount, we'll buy the shares back, because we think that's providing a signal of confidence that the portfolio manager and the portfolio is being underappreciated and undervalued. Dividend policy, clearly very, very important for any income hunters out there. Perhaps less so for capital growth seekers, but nevertheless it all helps. And clearly anybody seeking a combination of income and capital will be interested in this. The current average universe yield of Association of Investment Company members is 3.1%. There's an incredibly wide range there. And I think what's particularly interesting here is that the AIC every year publishes its Dividend Heroes list, and it's just done the new one. 20 investment trusts have increased their dividend every year for at least 20 years. 3 have managed it for 50. City of London, Bankers and Alliance Trust. 7 more have managed it for 40, including Brunner, JP Morgan, Claverhouse, Murray Income and Witan. That's a pretty stellar record, and clearly tells you that these are well-run, long-term investments with a clear eye on the shareholder return. And so I think that is, one of perhaps the biggest selling points of many investment trusts. Also note that again, the quest for income, AIC members have responded to it. Nearly half of members now pay quarterly dividends. That's up from less than a fifth 7 years ago. And there are even 5 investment companies that actually pay monthly dividends. Eddiston Property, F&C Commercial Property, Fair Oaks, SME Loan and 24 Select. Now they aren't going to be for everybody. Certainly SME Loan, Fair Oaks, 24 Select, they specialize in certain niche debt markets, which are potentially high risk, so they won't suit everybody's investment goals. But if you're looking for regular income, it's an option to consider, providing you're comfortable with the underlying philosophy and style of the investment trusts. This next chart, I'm grateful for the Association of Investment Companies for the data. It just shows you the historic discount to net asset value on a monthly basis for AIC members. And as you can see, this is where you can get a real double whammy with investment trusts. If you was to say buy, puff your chest out and buy in spring 2009, when the average discount was 18%, you were going to get a double whammy. Because one, the underlying value of the portfolios is going up, and two, the discount to net asset value is going up, providing a sort of gearing or double whammy effect. Equally, of course, that can work in reverse. So if you'd bought in late 2005, early 2006, when the discount was very narrow, the underlying assets then fell as the great financial crisis struck, and the discount widened out. So it is, again, something that you need to consider. Clearly, in a perfect world, you buy when the discount is bigger than average, and be a little bit more careful when the discount is narrower than average. Now, as we can see, stock markets have had we know that most asset classes have had a good run. The discount is historically, it's fair to say, quite narrow now. Research from the investment bank Stifel shows that the discount has actually only widened in two areas over the last 12 months, Europe and European smaller companies. And I guess that reflects market concerns over the upcoming French and German elections, as well as, for that matter, the Brexit vote and what it means. Another 11 sectors have actually seen their discount narrow quite markedly by more than 2 percentage points in the last year, including Asia Pacific, global equity income, surprise, surprise, property and technology. I think there's one investment trust, Lintel Train, that trades about a 30% premium. Now, I'm not saying don't pay a premium, but because in some cases, like say the infrastructure funds, then it's possible that the book value, the underlying value of the portfolio, isn't fully reflected in the book value. But I think you probably do need to be a little bit careful here, because if you pay a premium, you're clearly factoring in future returns that have yet to be generated or future dividends that have yet to be paid. So you are potentially giving away a little bit of your future returns by paying a premium. Scottish Mortgage, which has just gone into the FTSE 100, went in on a 5% premium. That's come back a little bit to 2% now. The stock historically has traded at a small discount. So again, just keep an eye on the discount. It can be your friend if you catch an investment trust at a big discount, when it's out of favour, when its underlying asset class has done badly, but the fund manager is still clearly very competent. That can be a great thing. Equally, paying very narrow discounts or premiums is something you need to consider if there was an accident, fund manager left, or again, there was an unforeseen shock in that particular asset class or geography. One technicality associated with investment trust that I flagged earlier was the use of gearing. Investment companies can borrow money or gear up to magnify income and capital returns, but again, it can work the other way, and it will magnify losses if the underlying assets fall in value. The current industry average gearing ratio is around 7%, so it's not too high. Some clearly have zero, some do go into the teens or even a little bit higher. And the last thing to look at, read the report and accounts and look at the board. The board is there to monitor performance, make sure the fund manager is sticking to their mandate, demonstrating their style, and ensuring that your interests are aligned with those of the fund provider and the fund manager. So make sure the board's got the right skills, really make sure that they own some shares in the investment trust so their interests are definitely aligned with you. And do bear in mind that if the board thinks that the fund manager is doing a rotten job, they can sack them, or they can change the mandate of the fund. So they are there to work for you. Make sure they are. So I know that's a lot to take in about 30 minutes, but that is an overview of what an investment trust is, how it differs from other types of collectives, what their strengths are, what their potential weaknesses are, and what you should research when you're looking perhaps for one as part of your portfolio, if you feel they're suitable vehicles for you. They serve a great potential purpose: risk management and diversification, the trade-off being the fee that you pay in return for hopefully premium performance on the upside, premium less downdrafts on the downside against your own time, and also the diversification benefits that you get, all of that in exchange for the fee that you pay. I suspect in the end fees are only going to come down because of competitive pressure from rival products like passives, like trackers, because of pressure from you, investors, and because of pressure from the regulator, the Financial Conduct Authority, and competitive position pressure within the industry. The closed-ended structure is very unique to these particular types of companies. It has its advantages in terms of the flows, and it does help the fund manager take a long-term view. Now, MiFID II is the next round of European regulation coming up in 2018. There was a risk at some stage they were going to be classified complex instruments because they don't fit by these UCITS European rules. that may have meant, in theory, had you wanted to buy an investment trust through us, for example, you'd have had to fill in a form to say that they were appropriate for your needs. And I don't think that's the case, I'm delighted to say. But also watch things like gearing, discounts to net asset value, dividends, buyback policy of the board. Again, there's less research involved than there is when researching an individual stock or company, but there's still some that you need to do. And even if you go down the investment trust of investment trusts route with somebody like Peter Hewitt, you need to make sure that you like his style, trust his performance, and of course make sure that the fees he charges provide you with value for money over the long term. So thank you very much for your time. We've now got hopefully 20 odd minutes of question and answers. We had 3 in advance, one of which was what is an investment trust and how does it differ from unit trust. So hopefully we dealt with that. And then with the next one was how to follow and compare them. I've given you lots of different websites and information sources to use, all of which are free. And then the third one was comparing unit trusts and OICs with investment trusts. And again, hopefully I've dealt with that. So that's 3 questions that I've already had and dealt with. Now I'm just looking at the screen here. We got somebody trying to watch Netflix at the same time. Oh, I'm sorry about that, but I hope at least it was a good film. I know exactly where you're coming from there. Will a copy be sent to the presentation during due course? Yes, we will email you a link along with a feedback form, so you will be able to look at the slides then. So where are we now? How do these firms work at investing in private equity firms? Well, here what you have is the private equity firm. Let's say it's John Moulton of Better Capital, for example. He will have a portfolio of holdings, and you will buy a share in that portfolio of holdings. So in some ways, it's no different from say a portfolio like a classic UK investment trust, except that Moulton's holding in Better Capital are companies that aren't quoted publicly. He will own the whole company. He will be working to a different time horizon, maybe 3, 5, 10 years or longer. He will eventually look to turn that asset around and sell it. Now, he's had a few accidents recently, CityLink being one of them, but that's the principle here. Private equity, they own firms that aren't quoted. In theory, it gives them a longer time horizon. A normal investment trust, certainly on the equity side, would probably own quoted shares. So that's quite right. They are private companies that aren't listed. What's my view of the impact of the Trump reflation trade on investment trusts and the scenario which is unfolding? Okay, now this is a terrific question. For those of you who can take the strain, my weekly blog on the Youinvest website will deal with this on Friday. So without wishing to give too much away, my conclusion is to quote Warren Buffett, which is, when you start mixing your politics with your investment decisions, you're making a big mistake. Don't forget that President Trump's going to be in charge for 4 years, maybe 8. But as we discussed already with, say, equity investing, this is a 10-year plus thing. So first of all, remember that his ability to make a difference in time is relatively finite. Secondly, Trump is being seen as pro-business, yeah? Okay. George W. Bush was seen as pro-business. The Dow Jones Industrials fell by 18% during his 8 years in office. Bill Clinton was seen as being of the left and anti-business. Many Republicans tried to paint Barack Obama as a right-out socialist and very anti-business. The Dow Jones doubled under Bill Clinton and under Barack Obama. So yes, politics creates an awful lot of noise and it keeps commentators like me really busy, for which I'm enormously grateful. But I actually think in the long run it doesn't make too much difference to your investment returns. What makes difference to your investment returns are company cash flows and valuation. And think about it. George W. Bush took over after a bull market when valuations were very extended. Bill Clinton and Barack Obama took over after bear markets when valuations had just collapsed. So it may have been a coincidence, it may not, but in the end, that's why stocks did well under Clinton and Obama and did badly under Bush. So it's going to create, you're quite right, it's going to create a lot of noise. There's disappointment that Trump hasn't been able to get healthcare reform through, because if you can't get healthcare through, can he get tax reform through, infrastructure spending through? Can he get a deregulation through? I don't know is the answer. And frankly, therefore, investing on the basis of something which you view as entirely unpredictable probably isn't a good idea. And so in that respect, I would stick to fund managers or trust managers who have a core process looking at screens, mechanisms that focus on the long-term cash flows, long-term growth potential, long-term business model, because that's an awful lot more predictable than trying to guess what somebody like Mr. Trump's going to get up to. Are all exchange-traded funds index trackers? In a sense, lots of them will track a well-known benchmark like the FTSE 100, America's S&P 500, Germany's DAX. But as I mentioned with things like factor investing, or what are known as smart beta funds, heaven forbid, they will create their own index for which they screen looking at earnings growth or dividend yield or governance factors. So they will all track an index of some kind, but some of them will actually be manufactured by themselves to give you the chance to invest in something quite specific rather than something with which perhaps you're already very familiar. Now on that funds chart of those 4 blobs, does the risk increase from bottom left to top right? That's an extremely good question. I don't think the answer, I think the answer is, I guess the tracking error potentially does, in that the fund manager isn't following an index, so there's going to be a bigger difference between their performance and not. But in the end, risk in terms of a tracker, well, if the index goes down or the basket goes down, the tracker's going to go down as well. So in that respect, I would argue personally the risk is no different. Yes, there's a greater risk of underperformance with an actively run fund, but to say that the passive run fund brings no risk, well, that's not true, because they're delta 1 funds, which means they match exactly in step, 1 for 1, with the underlying. So to say that passives are not risky is not correct, because the FTSE 100 has twice in the last 15 years halved. Could do again at some stage. I don't have a crystal ball, so I don't know. But if it did, the delta 1 fund would halve as well, the passive fund. I think an active fund manager would argue under that circumstance, they'd do a better job and go down a lot less. Because the danger with a tracker fund is that the tracker is inherently overweight. The biggest stock is inherently more exposed to the biggest stocks of the index, which are the ones that are potentially done best, the ones potentially the most overvalued. What's likely to be driving the trend in the historic discount to NAV data? That's a good question, and that's for all AIC members. I think what's interesting is if you were to overlay that chart with just 1 or 2 indices, the FTSE 100 or the S&P 500, there'll be a pretty close correlation. So I think, again, discounts tend to widen when markets are going down, and discounts tend to close when markets are going up. And that's a reflection of greed and fear, and investors wanting to get involved when things are going well and wanting to try and minimize or minimize their risks and get out when things are going less well. And so I think, again, it's a reflection of broader market sentiment, broader performance overall, but you will see that within specific areas. There'll be periods when emerging markets are very fashionable, performing incredibly well. The discounts will close up perhaps more quickly than in other areas and then widen out when things are going difficulty. What's so odd about 3i that it's excluded? That's a great question. The AIC provide numbers including and excluding 3i. It's just that 3i is so big. It's a multi-billion-pound investment trust. There aren't many of them like that, so it just, because of its sheer weight, it can skew the numbers. But 3i has actually been a brilliant turnaround story. I know that they're in the news right now because they've taken a big hit on Agent Provocateur, the high-end underwear chain, which has cost them a lot of money and actually gone quite badly wrong. They bought it from Vivienne Westwood's son, and they've now sold it onto a company in which Mike Ashley, the entrepreneur from Sports Direct, has a stake. I don't quite see the synergy there myself, but I'm not going to second guess Mr. Ashley. He's a lot richer than I am. But the reason that 3i tends to be excluded is simply because it's enormous. Is it risky to hold all investments in investment trusts? You are taking risk because clearly the manager can make a mistake, make some bad picks. The underlying could go, the UK market could go down, and that would be a problem for UK managers. But I think you are getting expertise in exchange for a fee. You are getting diversification in exchange for a fee. And if you're very inexperienced, I would argue to the Financial Conduct Authority that somebody paying for an investment trust that, yes, will go down when the market goes down, but maybe by less, and in theory goes up, it goes up by more when the market goes up. If the fund manager can demonstrate that outperforming consistently by 2 or 3 points a year, then frankly I would happily pay them 0.75% a year for that privilege. No problem. If the fund manager just tracks the index, then why on earth should I pay them 75 basis points when I can get a tracker for 0.07? So in that respect, you can get, it's value for money that these people need to demonstrate to you. They will, if their index, if their target market goes down, it's going to be very hard for them to go up, just the way it is. But they can demonstrate risk management through diversification, through expertise. They will help you manage risk. They certainly won't help you eliminate it, no. Is a buyback policy for all funds publicly available? Yes, it's in the report and accounts. So I'm afraid you have to ferret it out, but it always is in the report and accounts. If there is one, there might not be. If there isn't, then I would suggest as a shareholder you have every right to ask them why not, and if not, why not? What are the disadvantages of investment trusts is a good one. I mean, in the end, yeah, we've already discussed one. If the UK stock market were to collapse tomorrow, most UK investment trusts investing in UK equities would probably go down in value by varying degrees. So that they're not a magic wand in that respect. But the other risks, the fund manager makes a mistake, a trusted fund manager leaves, is obviously always an issue. You know, and then again, you have to go back to the process, the succession plan. Who's come in? Have they been groomed for it? Are they inculcated in the culture of the trust and the fund provider? So there are clear, and gearing does bring risk, and it magnifies returns and it magnifies losses. So you do need to look at all of these things when you're doing your returns. Yes, there is risk, but they are in the end there to help you manage these risks in terms of the underlying portfolio. You then need to assess the risks that are associated with the particular trust itself. It's worth noting that Edison and McCarthy are a good source of investment trust info. Yes, that is correct. Stifel, Edison, and Canaccord Genuity have very strong, dedicated teams who research investment trusts. I appreciate that for you people, getting hold of that research is tricky because it's actually designed for the institutional market generally. If you can get your hands on it, it can be useful, but again, please bear in mind, that's just their view. It's not the gospel. You know, they will also get things right, the brokers, and they will also get things wrong. But they will provide you with some very interesting data on things like discounts or gearing or dividends, and do a lot of the donkey work for you in terms of the comparatives. And that was the next one here. How do investment trusts compare with ETFs? I mean, we touched on that briefly at the start in terms of passives. ETFs in general will be cheaper. End of discussion. And that's going to be one of their key selling points. The ETF, the tracker, will then follow the index, either a well-known one like FTSE 100 or one that they've created for themselves on the basis of a sector or a theme. They'll follow that up, deliver that performance minus their fee, but they will also follow it down minus their fee. An investment trust in theory should not hug any benchmark. It may be measured against one, but it certainly shouldn't hug it. It should take strong views to generate risk-adjusted returns, but it will in theory vary more relative to the benchmark on the way up, and in theory go down less on the way down. But that's not going to happen all the time, but that's very much the theory. That's what you're paying the fund manager for. So there is a difference there. The investment trust will be actively managed. There will be greater tracking error. It is more expensive, and in exchange for that fee, the value for money you should demand is premium outperformance and less shallower dips. The tracker will mechanically follow the index, and no more and no less. What is my opinion of a trust that has a huge premium like Linseal Trail? Can it ever be justified at 30% plus? Well, I mean, the investment trust has got a brilliant performance record, and that's clearly why it's trading at a big premium. I'm not allowed, I should stress, to make my own investments because I'm talking to you people. We don't want any of you thinking I'm taking the mickey by talking about things that I have selected and own personally. So all of my money is run discretionary. If I was allowed to run my own money, I don't think I would buy an investment trust personally at a 30% premium, no matter how brilliant and how good the long-term record of the fund manager is. Why do investment trusts trade at a discount? Again, this comes back partly to market psychology, greed and fear. It's simply a function of more buyers and sellers, or perhaps not so much that, but because it's mathematically impossible to have more buyers and sellers. You need the number of sellers to match the number of buyers so the shares can trade. It's the intent shown by the buyers and sellers. If buyers are more determined, then the price will go up. If sellers are more determined, then the price will go down. So it partly reflects market sentiment. If everybody's suddenly panicking about emerging markets because, heaven forbid, a war's broken out somewhere, or the oil price has collapsed, or there's been a military coup, or a president's been impeached, or the economy's dropped in a hole as they did in 97, 98, people will sell. All the people will rush for the cat flap at the same time. There'll be a deluge of sellers. The discount will widen. If emerging markets then come out, recover, oil price goes up, coup is defeated, sentiment improves, people will pile back in again. That's perhaps when you can see the discount close. It's largely due to market sentiment. It's also partly due to the fact that you're maybe pricing in fund manager error. maybe some tax implications as well, given that investment trusts are companies, so they do pay income tax. So maybe there's an element there as well. If you hold more than one global trust in a portfolio, how do you choose trusts which complement each other in a portfolio rather than duplicate each other? That's a great question. The good news is you can look at any investment trust and look at its geographic allocations in its fact sheet. You can look at their top 10 holdings straight away. You could certainly, for example, choose one like Scottish Mortgage that's very much growth driven, albeit I would stress at the fairly, riskier end. Tesla, Ferrari, Amazon.com, Baidu, Tencent are some of its biggest holdings. So, you're dealing with very skillful managers here, but you're dealing with stocks which are very expensive. And if there's a wobble, then, they could go down quite a long way quite quickly without touching the sides. Or you could go for something, like say Brunner, which is a very well balanced global trust, where there's probably focused more on long-term income and steady capital appreciation. And then you've got two potentially very complementary global trusts. I mean, Brunner's interesting. It's got a couple of big loan debts on its balance sheet. They're actually keeping a lot of cash on the balance sheet to make sure they can meet those liabilities in 3 or 4 years' time. Cash is acting as a drag on Brunner's performance right now, but when those debts are repaid, there isn't the cash drag. It wouldn't be the biggest shock in the world if the Brunner discount to NAV were to close, providing, of course, the fund managers keep demonstrating solid performance. So yeah, again, it's all down to research. It's easy to find out at the click of a switch, click of a mouse, what the geographic allocations are, what the sector allocations are, what the top 10 fund picks are, and then you can quickly work out what's complementary in terms of style, geography, or stock. I mentioned Mark Barnett a couple of times during our presentation. Any chance I could do one of my videos on perpetual growth and income and perhaps some of the other larger general investment trusts? Yes, of course. Absolute pleasure. I try and mix my videos up between ETFs, funds, and investment trusts, and I just tend to do it on the basis of what you guys and girls are buying or selling most actively right now to make it most relevant to you. But yeah, I'll get my glamorous assistant to write that one down, no trouble at all. Invesco, perpetual growth and income. Do I have a checklist for investment trust selection? Yes, I've had those 10 points right there. That is my checklist for investment trust selection. All of those 10 points that we saw in the presentation. If I just wheel, when you get the web link, you'll be able to see the short version, just the 10 points. That will come up on page 12, and then the remaining slides will take you through those. So yeah, thank you, Michael. So if you go back to page 12, that's my checklist right there for investment trust selection. You normally pay stamp duty in investment trust purchases. Yes, you do. Why is it not charged on JP Morgan Global Convertibles? Don't know. Honest answer. I will find out for you, I promise. Thank you very much. Please email me at russ.mould@ajbell.co.uk, and I will try and find out for you. I do not know the answer to that. It's a great question. Thank you very much. Are there any data sources that allow you to compare holdings in investment trusts beyond the top 10? I would think if you were to go to most of the companies' reporting accounts, they'll give you the full list, to be honest. Though I accept that's only a once-a-year shot, but that will give you a much deeper look at what the portfolio is, albeit I accept with a time lag. Do you need to be cautious with investment trusts with a smaller fund size? Liquidity issues, would it be taken over? I guess liquidity is an issue. The bid-offer spread, that may, again, impact the liquidity of the shares, may impact the discount to net asset value, the bid-offer spread. Yeah, and it is possible you could see some consolidation in investment trust because of fee pressure or size. I've mentioned Threadneedle, that Threadneedle UK investment trust is merging with Henderson Eye Income because the board of the Threadneedle UK Select Investment Trust felt that the discount to net asset value had been consistently too high. They tried to do something about it and had failed, and therefore simply felt that the vote from the shareholders was that they perhaps weren't happy with performance and it was time to do something else. So yes, you do need to be cautious with some of the smaller ones. But again, if you're in it for the long term, you probably aren't so worried about that. And also, just like any other investment, one thing you shouldn't do with investment trusts is over trading them, because you're constantly racking up dealing fees, commissions, stamp duty, tax if it's in your dealing account, any gains and income. So yeah, again, don't over trade these things. So yes, liquidity is nice to have, but don't forget with certain types of assets like infrastructure or private equity, the illiquidity premium is there. That in theory is one of the reasons why people buy those assets. They're reward, because they're patient, long-term assets. You can potentially generate a premium return from them as a result. hence the illiquidity premium. In the near future, how can I use trust to protect my sterling savings from devaluation if Brexit causes the pound to fall further? Now, if that's your view, and I stress if that's your view, obviously one way you can go about it is to invest in investment trusts that hold overseas assets, because then the pound will go down, and in sterling terms, when those overseas assets are translated back into pounds, they'll be worth more. So you could look at global funds, you could look at anything that invests overseas. That would be one way of going about it, very simply. Equally, you can invest in UK investment trusts that, let's face it, 3/4 of the FTSE 100's earnings come from overseas. So the FTSE 100 is a pretty good hedge against the pound going down, quite frankly, as we've seen since the referendum vote last June. Every time the pound goes down, the FTSE 100 goes up. So there are lots of ways of doing that. All I would say is, in the end, basing your investment decisions on currency movements alone is very brave, because second-guessing currencies is incredibly difficult. But one way you can hedge, and hedging is a great risk management tool, which to invest in overseas trusts, maybe a global one, or to maybe just look at a FTSE 100 one, because that in itself is a pretty natural currency hedge. Beta trackers, heaven forbid. Vanguard is well respected and does these. Your view, what is the projected yield of your adventurous fund to be launched in April? And I don't know the yield of the adventurous fund off the top of my head, I have to admit. I'd imagine, given it's adventurous, it's probably fairly limited, because the target there will be capital growth. Beta trackers, I mean, again, yeah, this is the sort of factor investing, smart beta investing, trackers not just following vanilla indices, but creating their own. Wall Street or balls a vacuum. And if there's a demand for a granular product, then believe me, the stock market will provide it. I have great respect for what Vanguard have achieved, but yeah, I think factor investing is like one of these things. It does enable people to charge premium fees, which is why product providers will start to roll them out. But equally, it can help you target certain themes. But again, certain themes will do well at certain stages of the stock market cycle, and certain themes will do badly. So again, make sure that the theme is interesting to you, fits with your strategy, time horizon, target returns, and appetite for risk. And if it doesn't matter how clever a product it is or how cheap it is, move on. I think we've got time for one more question, because I'm conscious of all of your time. I've got a few left here. We've got them. I'll try and get back to you as quickly as I can. Which sectors are poorly represented by investment trusts compared to funds? Off the top of my head, I can't really think of any, to be honest. Because you can get hedge funds, macro funds, private equity, venture capital. I think investment trusts do just as good a job of funds. So that was a quick one. You mentioned that many investment trusts have increased dividends for many years, but have the increases kept pace with inflation? That's a brilliant question. I'd have to go back and do the maths, is the honest answer to that. But I would guess that, certainly if you look at, Scottish Mortgage, which is a capital growth play when all is said and done, has actually managed to increase its dividends for 30-odd consecutive years. But yes, most of the increases over the last 10 or 15 years have been very small. So that is definitely something that you could do as part of your additional research. Yes, I would agree. So if you've got any, and I appreciate just looking at the screen here, we've got about 8 or 10 questions I haven't had a chance to answer. When you get the feedback form, put them on there, or just email the customer services team through the AJ Bell Youinvest website, or me directly at russ.mould@ajbell.co.uk, and we will answer those questions. But I'm conscious of the time. Very grateful for listening to me go on for an hour. I hope that was useful, and we look forward to receiving your feedback. I look forward to answering your final questions, and we look forward to hosting another event like this at some stage in the future. I think we also have an evening event face-to-face physically in May sometime, I believe 9th of May, I believe, on managing portfolio risk in volatile times. So hopefully maybe I'll see some of you there as well. So thank you very much for your time, everybody. Have a wonderful evening, and we look forward to hearing from you.